Can you describe the process, timing, deadlines, and tax implications of someone writing a check from their personal account to a C Corp, LLC, and holding company to get the checking account set up? So first off, you threw a bunch of stuff out there. There's only one that was actually a tax designation, and that's a C Corp. So assume that LLC and holding company is a partnership, an individual. In any case, you're not going to have a taxable event when you contribute it, because you're either going to call it a contribution or buying stock or a loan or any number of things. But it's not taxable under any of those. If it's over $10,000 that you put in, like you write a big old fat check to a C Corp, you're going to have some imputed interest if it's a loan. If it's a paid in capital, then there's no tax implications and it can return the money to you at any time.
Yeah, as far as the timing and deadlines of getting that checking account set up, the sooner the better. Is it fatal if you don't get it set up right away? No, but just get it done and over with. And this process, if you have one of those entity binders that we send you, just take that whole binder with you when you go to get your account set up.
Mm-hmm.
Everything they're going to ask for is going to be in that binder.
Yep. If we did it.
If we did it.
Yeah. If somebody else did it, then good luck. No, I'm just kidding. Usually they do one thing well, like they got the filing and then they're like, where's the operating agreement? I have to go get one of those. And then when they get the operating agreement, then it's usually like, all right, where are all the other members? They need to sign too. And you're like, oh crap, I should have done a manager manage. But like, there's always these little getches. If you just go to somebody who knows how to do it and works with banks, that's usually the easiest part. The cool part about like the holding company and an LLC that's basically a safe haven, like it's basically a virtual safe. Think of it like putting cash in your safe. So if you walk over and you put money in your safe, do you have to do an IRS notice? No. Is there a tax implication? No. What if I take the money out of my safe? Yeah, there's none. So I could be popping money in and out of there all day long, and there's just all you're doing is just running an account. You're supposed to keep track of what's in there is all.
Right.
How much did I put in? How much did I take out? But it's not a taxable event. So do you recommend making a cash deposit or loan on a capital contribution? So do you like to put money in exchange for stock, or do you like making a loan?
When I started my LLC, the initial money I put in what we call additional paid-in capital.
Mm-hmm.
My company's an S corporation, a professional limited liability company. But yeah, because I knew that if I need to, I could pull that money back out.
Right.
Tax-free.
It's really, there's people that like it, and I'll tell you what, without getting down too far a rabbit hole, if we do a paid-in capital, we're going to, or if we don't, if we loan, and we ever decide we're going to dissolve that company and take a loss, we're going to make it paid in capital anyway. We're going to contribute the loan actually to the company in exchange for stock at that time. So like, you're not super stuck.
And here's our general preferences for if it's taxed as a partnership, we make it a capital contribution.
Mm-hmm.
If it's an S corporation, we prefer that it be additional paid-in capital.
Because it's easier because you just have your capital account.
Right.
You just take it out.
If it's a C corporation, we prefer it to be a shareholder loan.
That's because you have a separate taxpayer and there's no tax liability. If it goes over $10,000, you got to have a little bit of imputed interest or pay a little interest. Yeah.